that compared to our original forecast way back in 2015, 10 years ago, what has happened is that stablecoins are usurping one of the roles we thought that Bitcoin would play, meaning an insurance policy for emerging markets, meaning the individuals in emerging markets whose wealth and purchasing power are destroyed regularly by bad fiscal and monetary policies or by corruption. And that is not happening. However, what is happening at an accelerated rate, interestingly, is the scaling of stablecoins, which I think have scaled to nearly $300 billion.
In the beginning, all eyes were locked on Bitcoin. The early crypto believers were convinced it would become the financial lifeline for emerging markets, a digital escape hatch from corrupt regimes, broken currencies, and relentless inflation. But a decade later, and especially during this latest Bitcoin dip, something unexpected happened. Bitcoin didn't disappear, but it didn't fully become the emergency tool many hoped for either. Instead, a different force rose quietly in the background, moving faster, scaling smoother, and integrating effortlessly into the daily survival strategies of people just trying to protect what little they have left. Cathie Wood, founder of ARK Invest, breaks down this shift with striking honesty. In her explosive new prediction, she argues that stablecoins, not Bitcoin, are becoming the true insurance policy for unstable economies. Back in 2015, she believed Bitcoin would fill that role. But now, 10 years later, it's the dollar-backed tokens doing the real heavy lifting. Surging to nearly $300 billion in circulation, they're giving ordinary people in countries with collapsing monetary systems access to something both powerful and simple: stability. And as Bitcoin's price pulls back sharply, that stability is attracting even more attention. This isn't just a technology pivot, it's a human one. It's about people finding ways to survive inflation, sidestep corruption, and hold on to value, not through ideology, but through urgent practicality. And in this quiet global revolution, stablecoins are leading the charge. Let's take you back to Cathie's Wood latest market analysis, where she predicts what's coming next for Bitcoin and stablecoins.
But the summary here is we are in a bit of a liquidity squeeze. We think it's temporary. There are three reasons. One, we've seen the Fed, as of the last meeting, not end quantitative tightening. Many people expected them to do it at the last meeting. We think they will do it at the next meeting, so that's December 10th. The second liquidity squeeze is related, and hopefully we can say now was related, to the Treasury general account. When the government was shut down, the Treasury's cash balances were building. They were not dispersing the cash. The government shutdown is over. It's going to take a little bit of time to ramp and get everything back to normal. But we think that source of a liquidity squeeze is behind us. And now we're dealing with the third, and it really has to do with interest rates. Will they continue to come down? The market had been thinking, yes, they would, and we'd get another cut in December. We think we will get another cut in December, and that the Fed will shift from what seems to be a hawkish tone right now back into a more dovish tone as we approach that date. We're seeing inflation really come down significantly. Maybe we don't have the government statistics, but we do have the bond market, which is helping us understand that as measured by the 10-year Treasury yield, the inflation expectations have been coming down for the last few months. We're in roughly the 2.5% range on that metric. Same is true for Trueflation, which is a real-time indicator, 10,000 items monitored, tens of thousands, I think it is, monitored in real time. And that metric is at roughly 2.5%. Now, it was down to roughly 1.5%, has come up here. Tariffs, of course, are a big reason. We think tariffs are going to wash through as well, and some may even come down. I think the administration is taking the election results, New Jersey and New York in particular, as a significant warning that if affordability does not continue to improve, the midterm elections are going to be very difficult for at least the Republicans. We're seeing other metrics, though, that suggest that affordability is going up. One of those is oil prices. West Texas Intermediate cracked $60. And there are cyclical and secular reasons for oil prices to continue falling. Housing prices and shelter in the CPI is roughly 40% of the CPI. Housing prices, new home prices have been falling for roughly a year. Existing home prices or home price inflation is down to 1.5%. And that will get into the CPI over the next year. And then finally, we're seeing a lot of technology indicators, and this is our bread and butter. The metrics we follow and the original research we do suggest that the undercurrents of deflation associated with new technologies evolving are building. And we would not be surprised to see a real break in inflation once the tariffs have passed through in the next year. Now, the burden of proof is on us. I've just given you three indicators that suggest inflation could come down significantly in the next year. But it has been stuck for the last year in that 2.5% range, give or take a little. So we think it will resolve on the low side of expectations. We're surprised at what the Fed is saying right now, the various Fed governors, especially because the employment indicators are weakening significantly. Sure, we don't have the government employment indicators, but ADP is out, and month after month now, they are saying that employment is either contracting or expanding very, very slowly. And we're also seeing new graduates. That unemployment rate is increasing more rapidly than any other cohort's unemployment rate. And I think the duration of unemployment for everyone is approaching 30 weeks. So these are indicators that suggest that the velocity of money it has already flattened out. And we think it will go down on a year-over-year basis. M2 right now is up 4.8%. If the velocity of money falls on a year-over-year basis, that means nominal GDP will probably drop below 4% or 3%. And nominal GDP includes both real GDP and inflation. So the combination at 3%, something's going to give. And right now it seems like the real side of the economy is starting to capitulate, as measured by labor, at least. As productivity increases, maybe it won't hit the real growth line, but it is hitting labor. And of course, inflation would be the other give. So we think this liquidity squeeze will pass as the government opens fully, as quantitative tightening ends, and as interest rates continue to come down in response to weakening employment and inflation indicators that are pointing down.
Are we in an AI bubble?
I love this question. And the reason I love it is many people are worried about that risk out there. In comparison to what was going on in the tech and telecom bubble is night and day. In the tech and telecom bubble, sure, you had some value investors saying this doesn't make sense. no one was listening to them. And you had growth investors just throwing money at the dream back then. The seeds that were planted in the 20 years that ended in the tech and telecom bubble have been germinating for the last 25 to 30 years. Back then, the technologies were not ready. The costs were way too high. We didn't get the cloud until 2006. We didn't get the first real breakthrough in AI until 2012, deep learning, and then the even bigger breakthrough in 2017, that was transformer architecture. And of course, we had the ChatGPT moment as in late 22. We think this AI story has just begun. We are in the first inning.
The economy is tightening, but not cracking. A short-term liquidity squeeze is in play, driven by delayed Fed action, government cash hoarding, and rate uncertainty. Still, inflation signals are cooling across bond markets, real-time data, and falling oil and housing prices. Job growth is stalling, especially for recent grads, and money velocity is slowing. If rates drop and quantitative tightening ends soon, markets could get breathing room. It's not panic time, but the system is definitely shifting gears fast. Productivity gains from AI are unfolding unevenly. Consumers are seeing real impact, while corporations are still catching up, weighed down by the hard work of transformation. Meanwhile, stablecoins are taking over roles once expected of Bitcoin, especially in emerging markets, and have become major buyers of U.S. treasuries. Crypto continues to lead as a liquidity indicator, and gold's price is rising faster than expected. All of this points to a financial and technological shift that's only just getting started. Let's watch more clips from the interview.
The only thing that I will flag as a nuance and is related to an MIT research paper that came out on this topic a few months ago, basically saying corporations aren't seeing any productivity gains because of AI. This is completely elusive. It is a bubble. And the only nuance here is for enterprises to restructure and transform completely, which they will have to do in this new age, is hard work, and it will take time. And yet, on the consumer side, it is flourishing. So I think that bifurcation is something that we think about a lot. But if Palantir is any indication, and we think it is, you have CEOs and strategic decision makers saying, we've got to do this or we're going to lose our competitive edge out there. And that's why U.S. commercial business was up 123% last quarter, far surpassing anyone's expectations, including our own. There is a strategic imperative now, and it will take time. It will take time to play out in terms of those productivity measures. Individuals are seeing big increases in productivity with these tools. That will percolate into some of the productivity measures. But we think the real productivity gains, the needle moving, it will start within the next year. And already we're still at 2.5%. So that's the starting point. So we're pretty excited about the implications for productivity and real GDP growth, which we think is going to accelerate to levels people cannot imagine now. Longer term, we're seeing that growth, real GDP growth globally, accelerate into the 7 to 8% range because we're in a technology revolution. The last time we were in a technology revolution, growth accelerated globally, real GDP growth from 0.6% during the 400 years, and Brett did this work, 400 years ended in 1900. For the last 125 years, we've been at 3%. So that was a fivefold increase in the growth rate. And here we are saying 7 to 8%. To us, that's conservative, given the kind of technology revolution we're in. We've never seen anything like it. I'll just add something here, Dan, because it is interesting watching the crypto ecosystem really be a leading indicator when liquidity is ebbing and flowing. I think that's primarily what's going on here. This liquidity squeeze that I mentioned at the beginning, we think is going to end within the next month. And that's probably the most important point. Sure, there are these competitive dynamics between the various L1s and L2s as well. And we're always doing deep dives because there is so much data out there. It is so transparent. But we think the restructuring of the financial ecosystem is also in the first inning. I was on CNBC with Andrew Ross Sorkin and made the comment that compared to our original forecast way back in 2015, 10 years ago, what has happened is that stablecoins are usurping one of the roles we thought that Bitcoin would play, meaning an insurance policy for emerging markets, meaning the individuals in emerging markets whose wealth and purchasing power are destroyed regularly by bad fiscal and monetary policies or by corruption. And that is not happening. However, what is happening at an accelerated rate, interestingly, is the scaling of stablecoins, which I think have scaled to nearly $300 billion. And the other side of that is this has become a natural buyer for U.S. Treasury securities. As China and other countries are diversifying away from the dollar, we've got a big force here, and we think it's only the beginning in the form of stablecoins, which are backed primarily by U.S. Treasury securities. What I didn't do in that CNBC article was talk about the impact of the increase in the gold price. I said all other things equal. Well, all other things have not been equal. The stable coins have accelerated, taking some of the role away from Bitcoin that we expected at least. But the gold price appreciation has been far greater than we expected. So net, our bull price, which most people focus on that one, really hasn't changed.
The divide between Bitcoin and stablecoins is becoming more defined, not more competitive. While one serves as digital capital, the other is rising as the preferred medium for transactions and on-chain liquidity. That's the crux of Michael Saylor's recent response to comments about Bitcoin's shifting role, following Cathie Wood's revised 2030 forecast. Wood had lowered her target price from $1.5 million to $1.2 million, citing stablecoins' explosive transaction growth as a key factor. Saylor pushed back, arguing that these assets occupy different lanes in the digital economy. He framed Bitcoin as a store of value, immune to short-term transactional trends and more aligned with property, equity, and gold. Stablecoins, on the other hand, thrive in fast-moving ecosystems built on proof-of-stake chains like Ethereum and Solana. Their scaling won't diminish Bitcoin's role, he claims, but rather reinforce the broader crypto infrastructure by enabling liquidity, settlements, and on-chain finance. Cathie Wood, however, pointed to real-world behavior in emerging markets, where stablecoins are increasingly replacing Bitcoin's intended use as an economic hedge. Her insight acknowledges a shift in consumer adoption, even if the long-term thesis on Bitcoin remains intact. Together, both perspectives highlight an evolving digital landscape where value storage and transactional efficiency are no longer bundled, but purposefully split. That split may not weaken Bitcoin, it might actually help define its next chapter. As we wrap up, do you think stablecoins reaching trillions will help or hurt Bitcoin long-term? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.